It's been crazy. Every day, the stock market seems to be making new highs, and the vibe is overwhelmingly positive. But with all this excitement, many people are saying the market is overvalued and correction could happen anytime. So let's take a closer look and see what's really going on. Let's take the example of the S&P 500. Before COVID, it was at 3,300 and now it's at around 5,600. That's nearly a 70% rally, which sounds impressive, right? But here's something to notice. After the initial crash, it hit a high of 4,766 in December 2021. Since that peak, it's only rallied about 17% over the last 33 months. Honestly, that's not a great return when you think about it. Now, let's talk about the Nasdaq-100. This one's been the overachiever. It has outperformed the S&P 500 with a 100% rally from its pre-COVID peak. But from the December 2021 peak, it is only up by 19%. If we look at the bottom of the COVID crash, the Nasdaq 100 has seen nearly a 300% rally. Crazy, right? But let's not forget the crash was brief and the market quickly bounced back. So what's next? There could be three possibilities. First, the market could rise. But let's be real. Considering the current economic conditions, this is less likely. Second, we could see a market correction. A 15 to 20% drop seems quite possible. The major support level appears to be around 4,500 to 4,700. Finally, the market might consolidate for a bit longer. This would be a time-based correction before any significant rise. To me, this seems the most likely given the current scenario. Is the market overvalued? Let's take a closer look. Here's the historic price to earnings ratio chart for the S&P 500. The current ratio is 24.5, which appears to be within the normal range, not a crazy valuation. Similarly, if we look at the Nasdaq 100, it also seems to be within the range. While some individual stocks may be overvalued, index as a whole appears to be fairly valued. So given all this data, the natural question is, should you invest now? On one hand, if the market continues to rise and you don't invest, you could miss out on the rally. But on the flip side, if you invest now and the market corrects by 15 to 20%, your portfolio could take a hit. But here's the thing. Historically, markets have always bounced back from every dip. So it's about weighing the risks and deciding what's best for your financial goals. What to do now? If you're already invested and sitting on good profits, consider booking some profits, especially where valuations are high. Keep some cash. Whenever market drops, you can add them in systematic way. Corrections always provides better opportunity to buy good stocks at reasonable valuations. If you're a beginner and want to start investing, consider starting with systematic investment plans rather than lump sum investments. Where to invest? Personally, I prefer ETFs. While individual stocks might perform well, they can also underperform. ETFs, however, tend to perform better over time because they have an internal mechanism to rebalance the portfolio. Let's explore some growth ETFs worth keeping on your watch list. You can track them and consider adding them to your portfolio whenever they are available at reasonable valuations. The reason I prefer growth ETFs over value ETFs is that historically they have delivered better returns. I'm going to discuss 5 ETFs, though there are thousands currently available in the market. I selected these ETFs based on their investment themes, past performance expense ratios, and price to earnings ratios. Let's get started. First one in my list is the Vanguard S&P 500 ETF. This fund tracks the S&P 500 index, mirroring its exact returns. With a low expense ratio of 0.03%, it holds 504 stocks and has a price to earnings ratio of 26.6. The portfolio construction is identical to the index, and it has delivered an annualized return of 13.11% over the past 10 years, which is in line with the index return. Next on the list is the Schwab Large Cap Growth ETF, ticker symbol SCHG. This fund invests in US large cap growth stocks and has an expense ratio of 4 basis points, with around $31 billion in assets under management. Price to earnings ratio of 36. It's slightly higher than the S&P 500 average. The fund holds 251 stocks with a significant weightage in Apple, Microsoft, and Nvidia, which together make up 34% of the total holdings. In terms of performance, it has delivered an annualized return of 16% over the past 10 years. Third on the list is the Invesco QQQQ, which tracks the Nasdaq 100, giving you access to the performance of the 100 largest non-financial companies listed on the Nasdaq. It holds 101 stocks and has $291 billion in assets under management with an expense ratio of 2 basis points. The holdings align with the Nasdaq-100 weightings and are looks like fairly balanced. The top 3 holdings make up 25% of the total holding compared to 34% in SCHG. In terms of performance, QQQ has delivered a cumulative return of 438% over the past 10 years, which translates to an annualized return of 18%. Next on my list is the Fidelity Information Technology ETF. This index fund invests in the MSCI Information Technology Index with an expense ratio of 8 basis points and $11.5 billion in assets under management. The top 3 holdings are Apple, Microsoft, and Nvidia, which contribute 47% of the total holdings. This value is 25% in QQQ and 34% in SCHG. This fund has delivered an impressive return of over 20% in the last 10 years. At the top of my list is the iShares Semiconductor ETF, ticker symbol SOXX. This fund is sector-specific fund focused on semiconductor stocks with a concentrated portfolio of just 30 companies. It has delivered remarkable returns of over 25% over the last 10 years, which is why it earns the top spot on my list. The fund charges an expense ratio of 35 basis points in exchange for these higher returns. Price to earnings ratio is 35. It's slightly higher than the Nasdaq-100, but provides strong exposure to the semiconductor industry. The holdings are well balanced, making it an excellent choice for those seeking to invest in this high growth sector. All right, let's do a quick recap. These are the 5 ETFs we discussed, arranged from highest to lowest return. SOXX, being a sector-specific ETF, has delivered the highest returns, but its future performance will depend on how the semiconductor industry evolves and how the fund managers balance the portfolio with the right weightings for growing companies. WU is at the bottom of the list with a 13% return over 10 years, offering a safer bet compared to the others. These are the ETFs I'm keeping on my watch list, and I'll consider adding them whenever they're available at a bargain price. Thanks for watching. I'll be back with more videos soon, so stay tuned.